Good afternoon. I'm Chris Swift, and on behalf of my partner Chris Winward and our sales assistant Sean Gammon, welcome to this edition of Shooting the Bull. Today we're going to discuss nearing a turning point in the cattle market. We have seen some triangulation take place or a wedge form in the cattle market, specifically the feeder cattle market, for close to 9 months now. In September of 23, we topped a large futures market price that we have been unable to exceed so far. This time frame that we're doing is trying to get through the fundamental aspect of where we have a shortage of beef cattle, and we're trying to ration that beef so we just don't absolutely run out of cattle or beef. So what we have been doing is we have been creating a triangle, and that triangle is marking time until the fundamentals begin to point to a more definitive direction. The Elliott Wave projects this triangulation in one of two ways, depending upon whether the market was going up or going down. And that's where we've got the real indecision right now, because on one hand, our market has been going up for at least 2.5 years. And the aspect of it is we triangulate, next most probable move should be back to the upside again. However, if we consider that maybe September of 23 was the top of the market in the future side of it, we're now here in 24, almost a year later, topping the cash side of it, which there isn't a lot of difference between those two prices. So that's where we're going to try to figure out and take just a few minutes to discuss some of the fundamentals, some of the agenda that's going on to see maybe which way we're going to break out of this triangle. So we look at it from the first aspect, and if you look at the bottom left there, you'll see that Elliott wave pattern that shows the price coming up, stagnating, and then moving higher again. What you can't see on the futures chart is that to the left of it, the market had been coming up from a really low price down in the 180s all the way up to that 280 plus price that we see in September of 23. Now, if that was only the top of a wave 3 or the top of an intermediate wave 5, and the price action from September of 23 to present is all a correction, then pretty much it should work out just like it is. Maybe we've already seen the lows in it, and this time frame coming up in July and August, where we tend to sell the majority of our cattle for the summer in those 2 months against the video sales, maybe what we're seeing here is the bottom end of it, and now we're fixing to project higher. Although the opposite side of that suggests that maybe the top was made in September of 23, and that initial A wave down was what we saw to the December low, making all of the price action from the December low to present the B wave with expectations of a C wave decline. What are going to be the fundamental functions that push us one way or the other? Well, let's see what we can recognize already from the agenda that has taken place. The most obvious is the consumer shift from cuts to the grind. We have seen increases in all of the trimmings, the lean trimmings. We have seen a really high price for the steaks, the roasts, the cuts, and we have seen a lot of those be put back on the manager's special towards the end of the counter and then eventually reground back up into hamburger meat. The packers continue to control the throttle, the throttling processing that restricts supplies out there, and it actually restricts cattle supplies, but it builds beef supplies. And that's what it's all about, is how much more beef can we produce per cattle. So there's another recognition of the end of the agenda that's already taken place. The cow-calf sector appears in no hurry to expand. They're having to deal with money. And right now, the money seems so good, it's hard to pass up for expansion down the road. So we're not seeing the cow-calf sector pull or hold back cows, hold back heifers to an extent that would lead you to believe that they are expanding. The longer this takes, the longer the agenda stays in place, and the less likely a need to expand into the future. Our last thing that we've seen is continued increased imports. There is obviously an increase in those, and even worse, a big decrease in exports. And the biggest reason why, from what I've read, is we're the fourth largest beef producer in the world, right at it. So we're not the biggest. Not only that, the largest beef in India is never used for beef production. The cattle size is never used for beef production. So we've got China as a big beef producer. We've got Australia and New Zealand, and of course, Brazil. All of those produce beef. The only difference in the US is we produce grain-fed beef. That's a big difference. And what we're seeing now is that grain-fed beef is really expensive and the world cannot afford it. And the US is having a little bit of a difficulty trying to afford it. So what do I think next? What is the agenda going to do next? Or what is it doing right now? It's conditioning the consumer to high prices. We're keeping these prices high. We're going to keep these prices high, and we're going to try to keep as fewer consumers buying beef out there so we don't run out or we don't run the price so high that we kill demand altogether. We're going to reduce production or increase carbon credit usage. When we reduce production, I think that's already in play. I think we're going to have fewer producers as we go down the road. We may have the same number of cattle, but I do believe we'll have fewer producers. And the carbon credit continues to be an unexplored fundamental that I don't know as much about as what I should, but I know enough about it that it really scares me enough to say that the government or any entity could use that in a harmful manner so quickly that very few of us could overcome it in a very fast manner. Elevating beef production with fewer animals and offering a lifeline to the dairy industry. That's all with the dairy beef cross that we've got. I don't see any changes in that other than it's growing, and it's growing exponentially and probably going to continue that way. And if there were anything that I'm just now noticing, it could be a potential unexpected consequence to milk production. It is very possible that with a lot of new processors coming on board, primarily for cheese, we could see a lot less fluid milk out there as that dairyman begins to explore what the benefits are for increasing the beef side of it as well as continuing to milk. So know that is a brand new avenue. It's about 18 months as far as recognition and really been talked about. So we know it's been going on for a long, long time, but now that we know that it is upfront, right along trying to increase beef production, it's got to be paid attention to. Eventually, reducing beef cattle production in the US. I know it's hard to say, but if you look at the trend line from 1975, and that's what everybody always tells me to look at, that's when we had the most number of cattle. Today, we have the least number of cattle. We have equal amount of beef production to last year. There's not a great big need for a whole lot more cattle. And I think the damning thing coming will be that at some point in time within the next 12 to 18 months, the beef cattle producer decides that they're going to expand. And when they do, that puts a lot more product onto the market for which it's not able to handle. What's the next most probable moves? Further triangulation in price until after the July and August video sales, where we tend to sell about 50% of this summer's inventory in those video sales. After such, a price decline, a price rise, I really don't know. But we go back to those previous fundamentals and we look at what the agenda has done so far. And if we have to think about what would spur the market higher, we have to consider what would increase consumer demand, increase consumer discretionary spending capability, probably some lower interest rates, and probably some lower prices of other items. Gasoline, probably being the biggest one that deflects that pocketbook or deflects that money out of our pocketbook and away from beef purchases or food purchases, is the ability to get back and forth to work. So these factors tend to be kind of weighing a little bit heavily. They don't seem to be finding a way to increase consumer consumption. That's just what I'm not seeing. And I could be dead wrong, and they might be able to, but we're at the highs. We're seeing cattlemen already having to do other things out there, explore different avenues, very low margins in some cases or some production aspects, with a tremendous amount of our margin depicted upon a rising price. We have to have the price to continue to go up in order to profit from. And from what I've seen, we just saw the cattle on feed report where we showed May placements extremely heavy. that spread between those cattle, between the May feeder cattle and the October fats was about $66. Now, today, with the September futures, feeder cattle futures against the February, we're in the $71 range. We continue to push those spreads between starting feeder and finished fat wider, making the aspects of fat cattle prices having to go up in order to profit, or we see further vertical integration that allows more participation on the beef. So let's take a look at these charts again here. We got the one on the left that depicts a higher market. The rally's not over with yet. The cash feeder cattle market leads the futures higher possibly. We get more sideways trading through the month of July, and without a breakout to the upside, I'm going to look a whole lot more towards that left-hand chart, right-hand chart, towards the market kind of coming to an end and saying, what is there left after this? We've sold 50% of the market right now. If the remaining is going to be less, yes, it might go up, but I might be full of really high priced cattle right now and in no mood to buy any more. So these are the two charts that you probably want to look at the most. Again, look to the left-hand side of each of those charts. You can depict what the Elliott wave looks like when we're in a triangular fashion. And what we're trying to depict is, was September of 23 the high, or was September of 23 a high? And we don't know yet, but the fundamentals over the next 4 to 6 weeks are expected to be able to help show that. One more thing I want to touch on real quick. This is the feeder cattle index, and we can see that from our low that we made back in 2020, I'm sorry, 24, 23, in 23, December 23, we got a 5-wave move up. We need to pay close attention to that, as well as when we look at the weekly longer term, we look at the 14 through 16 time frame, and we understand that what took place was we increased a tremendous amount of cattle production that we knew would increase beef production later down the road. Today, we have increased beef production that may not be quite as much as what the cattle production is. But remember, if we do begin to start expanding into cattle, I believe this would start to move down very quickly. So I hope this will be able to help you a little bit. Be sure to take the time to educate yourself more on futures and options so that when or if the time comes to manage your risk in a more heavily manner, then you are more prepared to be able to do such. And always feel free to call us here. We appreciate your phone call. We appreciate your business, and we like being able to help you. So on behalf of Chris Wimward and Sean Gammon, I'm Chris Swift. I hope y'all have a great rest of your afternoon.